ETF investing is the best, safest, and easiest investing strategy for most long-term investors. With this strategy, you won't buy the wrong stocks if you buy all the stocks. Or as Jack Bogle, the founder of Vanguard, once said, don't look for the needle in the haystack, just buy the haystack. In this video, I'll be sharing the 4 ETFs that you will ever need, and yet still be able to outperform most of the investors out there. So let's not waste any time and let's jump into the first ETF, the S&P 500 ETF. This ETF tracks the top 500 companies in the US, and it is considered the gold standard among ETFs. That's because it has a really long track record of doing well, outperforms 95% of the funds out there, and even has the seal of approval from Warren Buffett Gong Gong himself. One of the biggest reasons the S&P 500 is so successful is its criteria, where in order for a company to join the index, it must first be profitable over the last few quarters. And if a company has underperformed for too long, it gets kicked out. This creates a self-cleansing mechanism where you are always investing in the top performing companies at any given time. The top holdings of the S&P 500 consist of many familiar names such as Nvidia, Microsoft, Apple, Amazon, Meta, and so on. This is hardly surprising given that they are some of the largest and fastest growing companies in the world. In terms of sectors, information technology consists of 32% of the index, followed by 14% financials, 10% consumer discretionary, and so on. The S&P 500 has delivered an average annual return of around 10%. But there's a big caveat. That return depends heavily on when you invest and how long you stay invested for. For example, if you invested in the S&P 500 for any 5-year period between 1995 and 2025, your annual return could have ranged anywhere from as low as -6% to as high as 24%. But if you stretch that investment horizon to 15 years, the range narrows significantly to between 4% to 15% annually. So what this means is that there's a lot of volatility risk when investing in the S&P 500. But if you can stay invested for a longer period, this risk would reduce and you get closer to the average 10% return. Quick pause. If you are looking for the cheapest broker to start your investing journey, check out Interactive Brokers. It has the lowest fees for stocks, ETFs, options, and more. Not just that, Interactive Brokers lets you easily research stocks. Like, you want to check out companies' financials? There, here it is. You want to check out analyst ratings? There, here's a bunch of them. It even has free technical insights which tells you where the stock might possibly go next. So sign up to Interactive Brokers today, and let's get back to the video. So how can you invest in the S&P 500? One of the cheapest ways would be to go for this ETF called CSPX. This ETF has a very low expense ratio of 0.07%. This is how much the ETF charges annually for portfolio management and other admin costs. So a 0.07% expense ratio just means for every $1,000 you invest, you'll only be paying a 70 cents fee, which is incredibly cheap. Also, this fee is already baked into the ETF price, so you don't have to do anything about it. The ETF accumulates or reinvests its dividends so that you get to activate the magic of compounding. But more importantly, it is domiciled in Ireland. This means you'll only be taxed 15% on your dividends, as compared to getting taxed 30% if you invest in US domiciled ETFs like VOO, SPY, or even S27. Other than CSPX, you can also consider SPYL, which offers an even lower expense ratio of 0.03%. However, it is not so straightforward to buy SPYL in some brokers, such as Interactive Brokers. And if you buy it via the normal method, you may end up paying a higher commission. Nevertheless, if you are willing to take the extra steps to save on fees, I've put together a tutorial showing you the correct way to buy SPYL via Interactive Brokers. The next ETF is the All World Index. So even though the S&P 500 is a strong index, the world is a big place full of investment opportunities beyond just the US. By investing only in the US market, you are exposed to high country concentration risk, where if the US economy faces challenges, your portfolio could take a hit. In fact, there have been many periods when international markets have outperformed the US. That's why some investors prefer to cast a wider net by investing in top companies from around the globe, not just the US. For this, one of the best all-world ETF you could go for is VWRA, which comes with an expense ratio of 0.22%. Or you can also go for FWRA, which has a slightly lower expense ratio of 0.15%. 62% of the holdings are from the US, followed by 6% from Japan and 3.6% from the UK. And here, you will again see many familiar names such as Apple, Microsoft, and Nvidia. But this time, there are a lot more holdings, and by a lot, I mean a lot. WRA has over 3,600 holdings, while FWRA holdings are a little less at 2,422. Nevertheless, both ETFs gave similar returns, so you won't go wrong with either choice. Interestingly, even though the all-world ETF is much more diversified globally, its long-term annualized return isn't that far behind the S&P 500, delivering around 9% as compared to S&P 500's 10.7%. So if you want to diversify beyond the US while still capturing growth from the top companies worldwide, this is a smart choice to consider. However, if you are someone who wants to see higher potential returns and you have a much bigger risk appetite, then you can check out the next one, which is the US Growth ETF. The most well-known option is the QQQ, which tracks the Nasdaq 100 index. This index is made out of the top 100 non-financial companies, many of which are tech giants driving growth and innovation. But it also holds non-tech companies such as Costco, PepsiCo, and Starbucks. In terms of sectors, this ETF is quite tech-heavy. Close to 57% of its allocation is in technology, followed by 19% in consumer discretionary, which also has some tech names such as Amazon, Tesla, and Netflix. Many of the names in this ETF are fast-growing companies, and they have the potential to deliver higher returns. However, they also come with higher volatility. So during tough times, QQQ can fall a lot more as compared to other ETFs. That's why if you're investing in a high-growth ETF like QQQ, you need to be mentally prepared for big swings, whether it's up or down. Now, while QQQ is the most popular ETF for US growth, there are also a few other options as well. First, you have QQQM, which has a lower expense ratio of 0.15%. This is a much more cost-efficient choice, especially for long-term investors who want the same Nasdaq 100 exposure, but with lower ongoing fees. Second, you have SCSG, which has an even lower expense ratio of 0.04%. Unlike the QQQ and QQQM, which focus only on the Nasdaq 100 companies, this ETF tracks a broader set of large-cap growth stocks across both the Nasdaq and the New York Stock Exchange, and has over 200 holdings. This means you will still get big names like Apple, Microsoft, and Nvidia, but with a slightly more diversified mix that includes other fast-growing companies that may not be in the Nasdaq 100, such as Visa, Eli Lilly, and Home Depot. The index SCSG tracks applies a rules-based selection process that focuses on growth fundamentals, including projected PE ratio, projected earnings growth, price-to-book value, dividend yield, and trailing revenue and earnings growth. Because of that, even though SCSG holds more companies, its performance has historically been quite comparable to QQQ. So if you're looking for a growth-focused ETF with broader exposure and ultra-low fees without sacrificing returns, SCSG is a compelling alternative, especially for long-term investors. Next on our list, we have the Dividend ETF. This option is for investors who want a steady stream of income coming in every few months. Dividend ETFs generally invest in well-established companies with a strong history of paying regular dividends. And because these companies tend to be more mature and financially stable, dividend ETFs often carry lower risk compared to growth-focused ETFs. This makes them a safer choice for investors who want both passive income and more stability in their portfolio. For this, we have two choices. The first choice is SCHD. This ETF has an expense ratio of 0.06% and focuses on the top 101 high-quality US dividend-paying companies. The index it tracks selects holdings based on dividend yield, dividend growth, as well as financial strength metrics. So you will end up with not just reliable dividend-paying companies, but also financially strong businesses that have the potential for sustainable dividend growth over time. Some of SCHD's top holdings include household names like Coca-Cola, Pfizer, and Verizon, companies known for steady cash flow and consistent payouts. However, because this ETF is domiciled in the US, non-US residents who invest in it will be slapped with a 30% dividend withholding tax, which can significantly reduce your overall returns. So if you wish to save on some taxes while taking a much more diversified approach, you can check out VHYD. This ETF has a higher expense ratio of 0.29%, but because it's domiciled in Ireland, it will have a much lower 15% dividend withholding tax, making it a more tax-efficient approach for non-US residents. This ETF invests not just in US dividend-paying companies, but also in 2,000 plus large and mid-cap companies from all around the world, including Japan, UK, Switzerland, and Canada. This makes VHYD a great option if you want to earn dividends while reducing your geographic concentration risk. So, with that all being said, which ETF should you go for? Ultimately, it all depends on your investment objective and risk appetite. If you are a beginner who's looking to start investing, I would definitely recommend going for all world ETFs like VWRA or FWRA, as they offer the greatest diversification and good balance between risk and reward. However, if you are in your 20s or 30s and have a bigger risk appetite, you can go for growth ETFs such as QQQ, QQM, or SCHG to get potential higher returns. Otherwise, if you are a little more on the risk-averse side, but you still wish to get a decent potential return, you can then consider S&P 500 ETFs. And finally, if you are nearing your retirement or are just looking for some passive income, then dividend ETFs such as VHYD might be worth looking at. Anyway, that's all for this video. Hope you found this useful. Like, share, and subscribe as I'll be posting new videos every week.